Hey everybody, I want to welcome you back. We had a little bit of snafuzo last night, so I definitely have learned my lesson that I need to do it. So this is our educational and networking series. And what we decided to do, since we started a little bit late and it was just a little bit of rough, Harold very graciously agreed to come back and to share his presentation again so that we could record it and we can share it with you. We'll also share Harold's contact info. So if you have any follow-up questions, you can feel free to reach out to him directly. So you should be able to share, Harold, and I'll give you the show and you can go through it. And then we have a few questions that were asked last night that we'll end with.
All right. All right. Let's see here. And all right. Can you see that?
Very good. Thank you.
All right. Thank you. Well, yes, thank you for asking me back. So we can do this recording again, and then also for myself, just to kind of get myself kind of cleaned up last night too. I got a little frazzled there and pulled in the wrong presentation. So I'm glad we were able to start again. So thank you, Trevor, for having me back.
Well, thanks for coming back. And start with obviously telling a bit about yourself and then go right into it.
Yeah, absolutely. So for those that don't know, my name is Harold McGee. I am a real estate broker in the state of Texas, as well as a licensed life insurance agent in Texas. And a little bit about me, I'm from Austin, born and raised, enlisted in the Marine Corps in the 90s, got activated for Desert Storm, Desert Shield, out of the reserves, went back in for Desert Storm, Desert Shield, and then came back off active duty and went into ACC, Austin Community College, and then Southwest Texas State, which is now Texas State University, where I got my bachelor's. Got a job with Fidelity Investments in the early 90s, learned a lot about the stock market, had my Series 7 in 63, and kind of went through the 90s doing that, did some day trading. And then as the 90s started coming to an end, going into 2000, got into some commercial finance and lending, some mortgage lending, and then in the mid 2000s, I got my insurance license and my real estate license all in the same year, 2005. Then as in 08 and 09 kind of came around, I was able to, very fortunately, get some good referral business from a California broker who then asked me to take over property management for them. So I learned a lot about property management and went on and built a nice little property management system and brought on another agent with me to help me with the tenants and leasing. And then in 2015, I sold that business to him, sold my book of business to him. And I was just fortunate enough to, again, also learn something new, which is infinite banking. And I became very enamored with this concept and thought that all my real estate investors would love this, using the power of its leverage in building two assets on the same dollar. So I went and got my my kind of registration certificate for it, and have been practicing it ever since. And that's where we are today. So with that being said, let's go ahead and get started on building your own bank for your real estate business. So we start off, what is the infinite banking concept? What it is and what it is not, how it works, and then how to get started. It's based upon a book of Becoming Your Own Banker by R. Nelson Nash. Now, Nelson came out of the forestry industry and learned about long-term growth and planning. Also was a pretty big insurance producer and investor, and learning in the 70s when you had a very high lending rates going on because of inflation and what was going on with the economy at that time. It was very hard to hold assets on short-term loans that were ever increasing. And so uh, Nelson had come up knowing and remembering that he could borrow against his life insurance policy, where the rates in there are contractually guaranteed. And so, after learning that, he discovered or kind of put together this process for becoming your own banker and said, well, you can apply it for your investing, but you can apply it for everything that you do in your life. And so that's where he came up with becoming your own banker, and then has since brought out or written a couple other books, from uh, Building Your Warehouse of Wealth, um, uh, A Case for IBC, and a couple others. So what is infinite banking? Well, it's a closed loop financial system. So if you think of how the weather works, when the sun hits down on a water stream or river or creek or anything like that, it causes evaporation, which then goes up into clouds and reforms and then produces more rain. That rain then falls on into the rivers and runs down back in again. It's just a closed loop system. It also uses the power of unstoppable compounding. This is really something that I really want to impress upon you. If you look at this grid here, this is a penny that is doubling every single day. Now, there's not an investment out there that's like this, but I really want to use this to show you how compounding works, right? So you can see it doubling every day from 1 cent all the way up to $5.3 million by day 30. So if you apply this to this bar graph right here, you can see that in this interval is about every 3 days. So there are 10 3-day cycles here, intervals. You can see in the first 4 to 5 intervals, there's hardly any movement. And then all of a sudden, in the 6th through 10th interval, it just goes up significantly, right? But what if you wanted access to that money? Let's say in day 23, you had a really good deal come along that you wanted to invest in. Well, if this were doing this inside of, say, your bank account, you took out that $41,000, you would completely stop the compounding cycle. So 7 days later, you would not have access to $5.3 million. And so the infinite banking concept allows you to be able to keep this compounding, yet access the capital via a loan against the system, as opposed to a withdrawal from the system. So that's the big difference. It is powered by a specially designed whole life insurance contract that offers high early guaranteed cash value buildup, not based upon a high death benefit. It has tax-free growth, so when you receive dividends, you do not pay tax on that. And it's tax-free participating dividends, which is a return of premium, and that is compounding annually. You can borrow against the policy at any time, right? There's no qualifications other than just having the available cash value in your policy. There's no credit check, there's no payback required, even though you do need to service at least your interest in the policy. So the interest that you charge annually, you need to be able to service that with your cash flow. And then the other significant part is that all these policies are issued by a mutually owned whole life insurance. So there's 2 types of insurance companies: a stock insurance company and a mutually owned insurance company. Stock company is owned by outside investors, right? So a return needs to go to those investors. So that is leaving the system when you have a stock company. A mutually owned company is owned by the policyholders. So everything, just like that weather system that we saw earlier, everything is within that system. It keeps regenerating within your own system. There we go. Oh. All right, you can think of it like a water wheel. Let's say that this water stream is your free flow income. right? You need to have income in order to power these. So consider the water stream your income. That goes into it's turning the water wheel. The water wheel is capturing your income and pulling it up into a little reservoir and then pouring it down into a field that is providing water for a harvest that will then go on to grow and be sold eventually. It's all a self-contained system of providing income and equity. What can you use IBC for? What you can use it for a lot of things. It's not just for real estate investing, right? And you can say buy equipment for your business. You can finance the real estate or tenant improvements. Say if you had like a restaurant. It can also provide short-term capital needs, like when you have a loss of rent. You can fund a group owner or employee pension system. So let's say that you have a vertically integrated management system for your investing business. You can have your employees participate in a group system, and then that will then provide capital to be able to invest back into your investments. And then you can use it for, say, college, car purchases, weddings, household expansions or major remodels. And then also it has retirement planning. You can do long-term care from it. And we have different riders that we can add to it to help you with that. You get the benefits of both worlds, right? So in investment real estate, you have ownership, which is appreciation. You have equity buildup, positive cash flow, and favorable tax consequences like depreciation. In infinite banking, you have appreciation of your policies. You have equity, which is the cash value of your death benefit. You can leverage other people's money. So when you borrow money, you borrow it from the insurance company with your policy acting as a lien holder. That's it. And then you have cash flow in the form of your dividends. And then that also offers an inflation hedge because the rates on this are much more significant versus just say idle cash sitting in your bank, which by the way, you'd pay taxes on that interest that you earn, and as opposed to you don't do that here. So it'll help you be in more control of your money, help you expand your real estate, provide a replacement income for your family if something happens to you, and it also provides an additional source of money in your retirement. Insurance is not an investment because it is guaranteed, and it's guaranteed by insurance companies that go back to the mid 1800s that predate our tax system. And so it can provide you with coverage and security and safety and protection and confidence. Sources that you can start your bank with are cash and your cash flow. You can borrow from your 401k or take a distribution. And there's also distributions that if you're 59 and a half or older from your IRAs, and you can do that. It can also help you pay for those taxes by providing you that source of capital. My partner and I, we use the living balance sheet so we can work with you to help you set up your plan. And it is a great integrated financial representation of your life. Your next steps are to follow up with me, and then we can sit down one-on-one and take a look at what you have and what you want to do and start building your bank from there. This is my contact information. You've got my website. I'm a big user on LinkedIn, and then my email and my phone number.
Awesome, Harold. Thank you very much. So one of the things I thought we would do is there was at least a couple of questions last night. So I thought we'd make sure that we talked about it. And I know I asked the first question. I'm an old guy. And I'm actually at the stage in my life where I'm letting all my term life insurance policies expire. I tell my wife a joke. She's got till this date to kill me, or I'm worth half as much later. But
yeah,
but in all seriousness, it's when you get older, you just don't think about life insurance as much.
Right.
So you wonder, well, how could this work for me?
Yeah, so a lot of especially older people have come through, especially after the 80s. Um, and then rates going down since the 80s. A lot of people have all had really kind of converted over to the whole buy term, invest the difference, right? So you needed that term for income replacement while you're in your working years, growing a family, and now you don't have that. But this really is a dual function asset, right? You really are getting both, right? You're getting to have your cake and eat it too. So, but as far as getting insurance later in life, it's, especially when health may be more of a consequence than when you're uh, younger. The best thing is just to try it and see what the underwriters say, because with modern medicine, a lot of underwriters are approving now, maybe in some sort of rated table. It may not. It's just depending on the circumstance. But we also have other ways for older people to be able to own and control the policy, right? So they don't have to be the same person. The owner can be different from the insured, which can be different from the beneficiary, right? So, we have a client that did a survivorship policy with the parent and a younger adult child, right? And so that's not really about a death benefit anytime soon, especially when the parent's probably going to pass away before the adult child will. That's about estate transition, right? So the parent owns the policy and controls the policy, all of it, including the cash value inside the policy. So you can get insurance based upon adult children. You can do insurance based upon grandchildren, usually because they're direct lineage into your estate. They do have the a part of that. They have an insurable interest on you. So, and then also, if you have business partnerships, obviously you own a business together, you can do it that way as well. And maybe do it in a group type scenario where there's no underwriting or limited underwriting.
Awesome, thank you. And there was another question about how do you achieve the high cash value as quick as possible?
Yeah, absolutely. So Whole Life has riders what is known as paid up additional insurance. And so it allows you to, once you've paid your base portion of your policy, it allows you to buy additional paid up insurance one time. So it's not ongoing like your base policy. It's just a one-time purchase, right? So when you have extra cash coming, like you want to put it in the policy, you will do a contribution of paid up additional insurance. There'll be what's called a load come off the top, about 10%. That goes to actually pay for the insurance. And then the rest of it drops down into your cash value. And so then your annual, once your cash value kind of is assessed, when your dividends paid out, that then will also buy additional paid up insurance. So we just keep on doing additional paid up insurance, and then all the while, the base policy becomes more and more efficient with just your regular base premium. So it's this cash that, as it's building up, you're able to access a loan from the insurance company, because that just keeps on growing and growing and growing and compounding. So that's how we don't really sell for high death benefit. We sell for lower death benefit, high cash value. And then we have some other ways too, that if they've got even more cash available now and want to put it in there, we have to stay within what's called the MEC limits. MEC stands for Modified Endowment Contract, and that was derived in the late 80s, when in the 80s, many people were just dumping high amounts of cash into the insurance policies. And then the IRS finally come and said, well, y'all are treating this like investment because you're shielding all this income, right? And so they put limits on that based upon your insurance, the amount of insurance you have, and then look at a 7-year look back period. So We have to stay confined within those ranges, which we establish before we issue the policy. So we know what the boundaries are before you're fully committed to this.
Excellent. Very good. Well, I really appreciate you coming back. And again, we're going to share this recording with everyone who registered for the event. And you have Harold's contact information. Most of you have my contact information too, and I can connect you. So again, thank you so much, Harold, for coming back in. And I'm so glad you were able to finally do this. I know we've known each other for a few years, and
Yeah.
This was the first time I actually got the full presentation. So
Yes.
it was very enjoyable, and I definitely know you're passionate about it. I can tell.
Absolutely. Y'all hear me say the same thing over and over every single week at Ken's meeting.
So awesome. All right.
It was my pleasure.
I'm going to end the recording. Thanks, everybody. And we'll see you next month, third Thursday, 7:30 p.m. Central. Take care.